Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at my financial freedom stock portfolio that has now grown to a value of $172,000. In this episode, we're going to take a look at all the recent transactions that I've made. I sold out of 3 companies in the portfolio during the past month. We're going to take a look at all the current portfolio holdings and go over the passive dividend income I collect from this portfolio every single year. So before we take a look at my portfolio update, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and on this channel we talk about the stock market, go over everything dividend related, and of course we track the progress of my personal portfolio, which is the focus of this video. So now we're going to jump right into the portfolio update, and we can see my current financial freedom portfolio has crossed the $172,000 mark for the first time, and I'm up around 16.5% or around $24,000 in market appreciation on my current positions. And if we jump over to my Simply Safe Dividends account, we can see that my annual passive dividend income I collect from this portfolio is now at $3,603. So I am now averaging $300 a month in passive dividend income. Of course, I don't collect exactly $300 every single month. Companies pay out their dividends at different points throughout the year, but on average, if you take the $3,600 and divide by 12, that's pretty much exactly $300 a month in passive income flowing into my account. And this is $300 I do not have to go out and work for. I don't have to clock in hours at my job in order to earn this income. This income continues to flow into portfolio. It will get reinvested into more dividend paying companies, and this cash flow amount will continue to compound quarter after quarter. And currently the yield on my portfolio is at 2.1%, and my yield on cost, because I buy dividend growth companies, is now at 2.48%. So we're already starting to notice the effect of compounding within my portfolio. And we can see the beta is at 0.92, so slightly less volatile than the overall market. And something I always mention in all my portfolio updates is I do understand my dividend yield is very low, but one thing I always like to state is I am in my early 20s, I have a long investment timeline, and I'm not here for current income. I will not be actually withdrawing any amounts from this portfolio for the next 3 decades, so my goal right now is to buy dividend growers, companies that will compound over the long term, so I'm not focused on their current yield, I'm focused on their ability to pay out a growing dividend for over the long term going forward, and that's primarily why the current yield on the portfolio is considered low at only 2.1%. And if we take a look at the companies that I own, I focus on dividend growers. We can see last year my dividend growth in the portfolio was 8.5%, and my average over the past 5 years is at 9.6%, which is considered fast. So moving forward in the future, if my portfolio can average anywhere between 8 to 10% annual dividend growth on average, I personally will be very pleased, and that dividend growth combined with the consistent deposits I make into the account, I think will allow the snowball effect to work rapidly, and my annual passive income amount will continue to compound and grow at a very fast rate. And if you're a subscriber to the channel, I've been following along with my portfolio updates, you know I like to buy safe dividend assets. I'm not here to take on any excessive risk, and I buy companies who have a safe dividend payout ratio and have the ability to pay out their dividend for many years going forward. And if we take a look, 87% of my dividend income is considered safe, and the 13% of my income that's considered borderline safe comes from Bank of America and JP Morgan Chase, 2 companies which, through my personal analysis, I do believe the dividend is safe at this current level. I think Simply Safe Dividends is being more conservative with this borderline rating, just so they aren't wrong, but overall I'm not too concerned about a dividend cut coming from either of these companies at this current point in time. They have very safe loan loss reserves, and their cash flow is coming in at excessive amounts quarter after quarter. And if we take a look at the rest of my holdings, you can see they're all considered safe or very safe from Simply Safe Dividends, all have very high ratings and pay out consistent and growing dividends like clockwork quarter after quarter. And now we're going to move on to my portfolio spreadsheet that lists out all the underlying holdings within my portfolio and all the related financial information. So we can see I've listed out all the individual stocks that I own, and in total I have 18 positions within my portfolio. And if you watched my November 2022 portfolio update, I mentioned how my goal is to reduce the number of companies that I own in the portfolio, to sell out of my weaker holdings, and to only contribute capital into companies I believe are very strong and have the ability to produce growing cash flow for decades going forward. So during the past month, in December of 2022, I continued with that goal, and I sold out of 3 companies within the portfolio. The 3 companies that I sold out of included Lowe's, Southern Company, and Kimberly-Clark. So I sold out of 3 companies, and I moved that capital into existing positions within the portfolio. I did not add any new names, and I'm going to go over why I made these transactions and which companies got the excess cash flow I received from the disposition of those 3 holdings. So first we're going to take a look at my sell out of Lowe's. So when I sold out of Lowe's, it had a market value of $6,000, and I was up around $1,200 in market appreciation on that position. So when I sold out of Lowe's, my thought process was I already owned Home Depot and Lowe's within the portfolio before that transaction. So I thought I did not need both within the portfolio, and I took a look at both companies' financials. They're pretty much identical. Personally, I preferred Home Depot's balance sheet over Lowe's, which is why I chose that company. But I also took into consideration the qualitative factors. When I personally go shopping for home improvement goods, I've been to Lowe's, I've been to Home Depot countless times, and I personally prefer to shop at Home Depot. So if I share that perspective, I'm sure many other individuals also have that perspective of the two companies. So that's why I chose qualitatively why I chose to keep Home Depot within the portfolio. So when I sold out of Lowe's, I sold the $6,000 of proceeds. I threw $3,000 into Home Depot to increase this position, and then I distributed the other $3,000 into other companies I'm going to discuss moving on as I discuss the next transaction. So Lowe's and Home Depot, direct competitors, they pretty much do the exact same in their business. I just believe Home Depot had the stronger balance sheet, the stronger financials at this current point in time, just by a slight margin. And personally, my qualitative bias is toward Home Depot, which is why I sold out of Lowe's and I put half the proceeds into this company within the consumer discretionary sector. Next, the second company that I sold out of operated within the utility sector, and that was ticker SO for the Southern Company. This was a traditional utility giant that paid a nice high dividend yield above 4%. And if we take a look at the current utilities that I own in the portfolio, I now have Duke Energy and NextEra Energy. So Duke and Southern Company, I would say, are very similar to a Home Depot and a Lowe's. Both are traditional utility giants operating in very similar manners, just in different markets. Their balance sheets and their income statements grow at the same rate pretty much year over year, and I just decided I didn't need to own both within the portfolio. Taking a look at both companies, I think Duke's growth prospects are slightly better than Southern Company's, which is why I sold out of my $5,000 position in ticker SO. I only had a slight gain on that overall of around $400, and I took that entire $5,000 and transitioned it all into Duke Energy. So right now I own 82 shares of the big utility player, and it's worth around $8,400 in current market value. And why I considered to have Duke and NextEra within the portfolio is because although they're both utility giants, they operate in slightly different manners. NextEra also has a large part of their business in renewables, which I do believe is the future, and I think that's my way of getting a safe, reliable dividend payer renewable company into the portfolio right now. So the second company that I sold out of was Southern Company, the big utility giant. And now the third company that I sold out of was in the consumer staple category, and that was ticker KMB for Kimberly-Clark. If you're a subscriber to the channel and you've been following along with my portfolio since I began it, you know I'm a big believer in consumer staples. If we take a look at my sector values, consumer staples is the second largest, worth around 22% of the entire portfolio. So I'm a big believer in this sector just due to the consistency of their revenue and their cash flow over the long term through any type of market environment. So I sold out of Kimberly-Clark. This was not a major position, and actually in terms of market value, this was the smallest position in my portfolio, just worth slightly over $4,000. So I sold out of Kimberly-Clark and took that proceeds and put it into Qualcomm, which I will discuss in a moment. So if we take a look at my existing consumer staple companies after I sold out, I have Costco, Pepsi, and Procter & Gamble. So of course, Procter & Gamble and Pepsi are two traditional consumer staples, some of the strongest and largest in the world, and I'm a big believer in both brands going forward. And with Costco, some may consider it because it's a consumer discretionary company, but I do not believe that. I think due to the nature of the goods Costco sells, no matter what type of market environment we're going through, consumers will still choose to shop at Costco warehouses. And overall, we can see my consumer staples sector in my portfolio is very strong, and Costco and Pepsi are two major holdings, making up the third and fourth largest position in the portfolio as a whole. Costco is worth over $17,000 of market value, and Pepsi is worth $15,000 as of the last market close. So overall, I didn't think I needed Kimberly-Clark. It was already the smallest position in my portfolio. It was growing revenue at a minimal rate year over year, not much growth in the business. So I sold out of the company in December of 2022 and transitioned a majority of that capital into Qualcomm, which is a semiconductor brand that's taken a beating over the past year. So Qualcomm, I would say, is the biggest buy I made over the past month. I transitioned $6,000 of proceeds from the sale of Kimberly-Clark and some capital I had in my existing cash balance at the end of the month into Qualcomm, so I now own 100 shares with a current market value of around $11,000. And before this purchase, I had around $4,000 of market value, so I had around 38 shares in the company. So a significant addition to this position over the past month, and I'm still in the red overall by around 4% or $457 after my latest purchase. So if we jump over to Qualcomm stock chart, this company has taken a major decline throughout the past year and is down 40%. So I like buying companies when they're beaten down. If I liked this company when I first bought in at around $120 a share, I like it much better when it's worth only $110 per share. And we can see on the 52-week low, it's sitting right at that low with trading at a very, very low forward PE ratio of only 10.72, a nice dividend yield at 2.73%, and their market value has now fallen to only $123 billion. And after this major price decline, Qualcomm is now considered around 22% undervalued. The estimated fair value per share comes in at $141, so we can see a nice discount from their estimated fair value at this current point in time. And with Qualcomm, I have talked about this company in detail in previous videos, so I'm not going to focus on all the nitty-gritty of their financials in this episode, but overall, they pay a safe and growing dividend. Their payout ratio is only around 25% of their earnings. Their dividend is growing around 6 to 7% per year on average, and they do a great job of buying back their shares at a very fast rate. And we can see over the past 10 years, their share count consistently goes down quarter after quarter. So they've returned a ton of capital to their shareholders, which is a great sign, is exactly what I'm looking for in a potential portfolio holdings. And I do believe the semiconductors industry as a whole will grow going forward. So I do own Broadcom and Qualcomm in that sector. I just think as a whole, the demand for semiconductors will always be there going forward. These companies have very high margins. Their ability to generate positive cash flow is very strong, and they return a ton of capital to their shareholders in the form of stock buybacks and dividends. So I thought now is the great time to buy a beaten down company in the portfolio and increase that position. So Qualcomm has now grown to the 5th largest holding overall, worth just under $11,000 as of market close. So those were all the recent transactions that I made in my portfolio throughout December of 2022. I think I did a good job over the past 3 months trimming 5 holdings out of the portfolio. I do have a couple companies on my watch list that I may add going forward, and if I do choose to make those buys, I will of course make a video sharing my thoughts and my analysis on all the companies if I do add them and when I do. So overall, that was pretty much it. My portfolio, I think, held up very well throughout 2022. The S&P 500 fell 20% in the calendar year, and due to my continuous contributions into the portfolio, my reinvested dividends, my portfolio, I think, held up pretty well. Of course, I am down around, I think, 14% during the year. That's not because my portfolio is much better and I beat the market by 5%. That's not really the nature of why I'm down less in the market. It's just due to my consistent contributions that I was buying in at lower prices. So overall, my portfolio continued to perform very well. My annual dividend income has now crossed $3,605. So I am achieving my goal of growing this annual passive dividend amount at a rapid rate. And that's what I continue to strive to do throughout 2023. So overall, that was the update to end out 2022 in the portfolio. My goal for this calendar year is to continue to invest a couple $1,000s every single month into the portfolio. That will range because of my personal life and some different expenses I have coming up. So I don't really have a goal for the exact amount, but as long as I continue to trip you at least $2,000 a month into the portfolio, I do think that's a very strong goal that I will be able to achieve. And I want to see my annual dividend amount cross around $4,200 to $4,300 by the end of this year. So overall, that's the goal for 2023 and my most recent portfolio update with all my buys and sells. So I want to thank you for watching the video all the way to the end. Please hit that like button and subscribe if you already haven't done so, and I will see you in the next video.